Welcome to your AI-hosted show. Market update. Indices stabilized, momentum cratered, and one plumbing and HVAC distributor just gate-crashed the S&P 500. I'm Casey. With me as always, Priya, who sees opportunity in places Grant is still writing risk disclaimers about.
He writes them in advance, just in case.
And Grant, whose job is to ask who's holding the bag when the optimistic case falls apart.
Someone has to.
3 stories today. The weekend numbers. Stabilized indices, cratered momentum. Databricks now valued at $188 billion. Then the momentum crash. Biggest wipeout since 2000. And the question is whether the weak hands are gone or the deleveraging has further to run. And Ferguson surges 8% on S&P inclusion. Flush or false floor, Priya and Grant are already disagreeing. Let's get into the numbers. All right, the numbers. July closed on a hopeful note. Indices stabilized through the week, though the momentum trade saw its biggest wipeout since 2000. Ferguson Enterprises surged more than 8% on news it's joining the S&P 500, edging out another name for a spot in the index. And on the private markets side, fintech broker ClearStreet is offering pre-IPO access to Databricks, valued at $188 billion, through a new platform launching this week. Crypto pulled back Friday morning. Silver briefly climbed above $59 after the U.S. paused airstrikes, and the AI executive order is nearing a White House deadline, with the regulation debate still wide open. That's the tape. Priya, stabilized indices after a momentum crash. Relief rally building, or is the market just catching its breath before another leg down?
The momentum unwind was violent, but the fact that indices held through it tells you there's real buying underneath. This wasn't a market that had no floor.
Holding a floor after a wipeout isn't the same as being cheap. The question is, what's still priced in from the optimistic case that hasn't been repriced yet?
What I'd push back on is the assumption that more unwind is inevitable. When you see indices absorb that kind of momentum destruction and not break, that's not nothing. That's the market telling you the selling had a ceiling.
The ceiling argument only works if the people who caused the damage are actually out. And we don't know that yet, because systematic strategies don't deleverage in one shot.
Sure, but the velocity of what we saw. Biggest wipeout since 2000, as Casey read it. That kind of speed tends to mean the forced sellers moved fast, not slow.
Speed doesn't equal completion. 2000 is actually your counterexample, Priya, because that unwind took years, not weeks.
Grant, let me pull on that. Are you saying the 2000 comparison is a warning sign, or just that using it as a bottom signal is the wrong read?
The wrong read. The comparison tells you the magnitude of the dislocation, not that we're done with it.
I'll give you the uncertainty, but the buyers who showed up through this week weren't speculative money. If weak hands were still driving it, those bids don't appear.
2 real views on the table. Priya sees a durable flush with real buyers underneath. Grant thinks the deleveraging still has room to run. And that's where we'll leave the momentum debate. Next up, Ferguson, jumping 8% on S&P inclusion. And the question is whether that move has legs or whether it's already done its work. Priya, you like the setup here.
Index inclusion isn't just a one-day event. The forced buying from passive funds gets spread over days, sometimes weeks, so the initial pop doesn't capture the full demand that's coming.
That's the mechanics, and the mechanics are real, but mechanical demand isn't the same as someone deciding Ferguson is worth more than it was last week.
It doesn't have to be a fundamental re-rating on day one. The passive inflow creates a price level that then attracts active buyers who weren't willing to step in before inclusion.
Only if the active buyers think the stock was undervalued before. And the honest answer is, inclusion doesn't change the earnings, the multiple, or the balance sheet.
Grant, so are you saying the 8% is already borrowed from the future, or just that it doesn't tell us anything either way?
Borrowed is probably right. Buyers who had to buy already moved the price. And whoever holds it now is sitting on a gain built entirely on demand that won't repeat.
If the stock re-rates into its new index weight over time, the entry point for those passive buyers ends up looking fine. You're treating a structural demand shift like a one-off.
Priya sees ongoing demand from index rebalancing, building a floor. Grant says the mechanical lift is already spent. We'll move on from Ferguson and keep it rolling. All right, final calls before we go. Priya, where are your eyes next week?
AI-related flows. The money moving into that space has been consistent, and I want to see whether that demand holds or starts to thin out.
Credit spreads for me. If the risk that's been building quietly starts to show up there, that's the signal I trust more than the headline moves.
Spreads are worth watching, but they've been calm while the opportunity has been right in front of people. At some point, you have to weigh the cost of sitting out.
The cost of sitting out is only obvious in hindsight. The cost of being wrong when spreads start moving is obvious in real time.
Grant will be watching for the fire alarm while I'm watching where the capital is actually going. We'll see who had the better read.
Opportunity building on one side, risk quietly accumulating on the other. That's the tension heading into next week. And honestly, that's the show in a sentence. Thanks to Priya and Grant. Thanks to all of you for being here. Catch you next time. That's a wrap. Thank you for listening. Like and subscribe, and enjoy the rest of your day.